Hello, everyone. Hey, thanks for taking a few minutes here with us this afternoon and going over our first quarter webinar. Gary's got some great material again for us, so thanks for joining us. We'll just take a couple minutes here, let people get into the webinar, and then we'll get started.
Yeah, Lyle, excited to be here again. These quarters just keep going faster and faster.
Yeah,
And it seems like we keep getting here. I don't know. What is that? Should I continue to expect that each year goes a little faster the older I get?
that's what they say. They say each year you have the longer you live, each year is a little bit less percentage, so it seems like it goes faster and faster. I
All right,
like it.
that makes sense. That makes sense. And it's balmy. It's balmy out today. It's almost 60 degrees out
I
there.
know we could be in Florida right now. Hasn't been any
Yeah,
warmer
but
down there, I hear.
that's exactly right. I know. I know. It's if it wasn't so wet, maybe you and I would be trying to get out on the golf course today.
We're stuck in here doing a webinar, so oh well.
Hey, this is
It's good
nowhere I'd
too. It's
rather
good
be,
too.
Lyle. Nowhere I'd rather be.
I'm not going to touch that one.
No, this is great. We do look forward to this every quarter. Obviously, great to connect with everyone who's here and talk investments. That's what we love to do. And so hopefully there's some helpful information here today, or even just some perspective. And
Yep.
that's really what we're looking to offer here as we look back on 2023, we look ahead to 2024 and what's going on and how we're thinking about investing here at Masters.
Yeah, we'll use the same format as we have previously. The presentation's broken up in sections. We'll stop at each section. I'll be monitoring questions along the way, so please use the chat function or the question function at the bottom of your screen to put anything in there. Then we'll be discussing questions as they come up, and we'll let it roll. So probably good to go, Gary.
Great. All right. Well, thanks again for everyone being here today. Very excited to be with you and talk through some of what happened last year in the markets and just making sense of what was certainly a unique year in the investment markets. And what does that mean for 2024 when we look at positioning, when we look at asset allocation and the opportunities that are out there in the market, and what we're seeing from a data standpoint as well. As you know, we're data-driven investors here at Masters. And so, like I normally do, we've got plenty of charts and graphs for you today to lend some perspective to that. So I want to start out today with just looking back at 2023. And what happened in 2023 helps to understand where we stand here at the beginning of 2024. Now, the market doesn't keep a calendar. Now, we keep calendars as investors because it's easier to think of things in specific time periods, like 1 year at a time. But just remember, the market is just a day at a time. There's no calendar in the market. There's no magic to, oh, when the calendar turns, something resets in the stock market or something changes. So when we look at 2023, we're rolling right into 2024 armed with information about where we stand. And that's why it's helpful to look back and review. And so the first thing, just to level set today, is what happened in 2023. Last year ended up being a fantastic year in the stock market. What you're seeing here in the varying shades of green is what happened in the fourth quarter of the market. And then in the right column is what happened all of 2023. And as you can see across the top, the broad-based US market had a very, very positive year at just over 26%. So a nice bounce back from 2022. And that tends to happen in the stock market, is that volatility goes both ways. So when we get more volatility to the downside, like we did in 2022, we tend to get that volatility back on the upside at some point. And that's what we experienced in 2023. We'll get into some of the different parts of the market. See value on here and growth and dividend paying stocks. Those are all topics of discussion for today. But the other thing I want to point out here is the global markets. While not as strong as the US markets last year, both posted pretty positive returns. Developed markets, so that would be your larger, more developed economies, such as the UK, Germany, places like that, performed well, almost 18% last year. Emerging markets, some of your up and coming economies, about 12%. And we will get to the international landscape as well today, but just interesting to point out that even though they lagged the US market in 23, still a strong showing for global markets overall. And then what was really interesting about last year, which again we'll dig into more, is that bonds, the US core bond market gave you 5.3% last year. Very solid year, especially coming out of all these years of low interest rates that we've had, and then the worst bond market on record calendar year in 2022. We're starting to see that bounce back. We're starting to see the benefit of higher yields on just traditional core US bonds. And that's really important for investors because it changes some of the calculus and how you put together your asset allocation now that we can receive higher returns on relatively safe core bond portfolios, where if we were looking and trying to get more yield on our portfolio even just 3 years ago, we were trying to stretch for that and we had to find other places to generate yield. But with interest rates up, provides a nice opportunity for investors. So I want to start in 2023 to zoom in on how the returns last year were lumpy. They came in a small pocket of time throughout the year. And what you're seeing on this screen are the monthly returns of the S&P 500 for 2023. And what you notice is that we had 3 really positive months. They happened to be at the beginning of the year in January, which is at the bottom of the screen, returned 6.18% in January. And the last 2 months of the year, November almost up 9%, December up just shy of 4.5%. What that means is that 26% that the market returned, 19.5% of that came in those 3 months, versus the other 9 months of the year where you only got 3.35%. And so 85% of the total cumulative market return in 2023 came in only 3 months of the year. What does that tell us as investors? It's just a reminder that when we look at long-term averages on the stock market, we get to that long-term average with a very bumpy ride. And so whenever we zoom in too closely on the market, if we focus on what's happening in the market today or this week or even this month, and we start to base our investment decisions on a shorter term time frame, what can happen is we just end up missing the bigger picture, and we can almost trick ourselves into thinking that successful investing is day to day, week to week, month to month, when in reality it's year to year and it's even decade to decade when you're a long-term investor, like we are here at Masters. And so very interesting year last year as far as where the returns came. And just another warning, I guess I would say, that trying to time the market or trying to predict the market in these short-term periods of time is just very difficult to do. And it's very easy to miss out on these strong market returns that tend to come in these small pockets of time. And we saw that in the bond market as well, which I'll get to in a few slides, which is fascinating, especially for how it turned out in 2023. So we know we had a poor year in 2022. It was a really rough year for both the stock and the bond market. And so to give some perspective on that, this chart shows you how the market does after a large decline. Now, as investors, when do we get most nervous about how our investments are performing? We get most nervous when things are going down and they don't seem to stop going down. And so a year like 2022 as an investor could have been a nerve-wracking year. We're looking and we're seeing our portfolio declining in value. If I'm a balanced investor and I have slightly half of my portfolio in stocks, about half my portfolio in bonds, and I see both of them struggling to give me positive returns month after month, it can be a little nerve-wracking as an investor and make me question, hey, is this the right thing? Am I still in the right portfolio for this time in the market? But the danger in that is this chart behind me, which makes us most nervous when the market is at its bottom, and we risk missing what happens on the other side. And so what this chart is showing you is that after 10% decline returns, which are very standard, we typically get a 10% correction in the market almost every year on average. So that's a normal volatility for the market, versus after a 20-year decline versus after a 30-year decline. And the red bar is what happens the year after that on average in return. The gray bar is what happens over the next 3 years, and the green bar is what happens after the next 5 years. And what you see is a common chart line of 1 year we do well, 3 years we do even better, 5 years we do even better than that. And so the question is, why is that? Why does the market tend to bounce back after a large decline? Well, very simply stated, and it's a little more than this, but if we're boiling it down to one thing, the conclusion is, well, when the market goes down, it means we can buy investments for less than we could before. And so when we're buying at a lower value and we're buying at a lower price, our expected return in the future is higher. And so at a very fundamental level, when we see a market decline, what we want to think about is, oh, the market's down. Yeah, it's not fun. It makes me a little bit nervous about my portfolio, but it also means that stocks or the investments in my portfolio are on sale. And so they're cheaper and I can buy them cheaper than I did before. So if I have new money to invest after a market decline, it's a great time to do it because I can get in at a lower price. Or if, like we do here at Masters, you have a systematic rebalance on your portfolio where you're constantly looking at, okay, when stocks go down, but bonds hold water, I want to move money from bonds to stocks. That's another way to take advantage of these market declines and buy at lower prices. To look at 2022 versus 2023 in a different way is these two charts. Now, there's a lot going on in these two charts, so I'll attempt to explain to you what we're looking at and then just point out the trend line that I find very interesting. So this is called the Morningstar Style Box. It's something that we look at Masters to track the different pockets of the market. And what you have down the side, which fills up the rows of the style box, are different size stocks in the market. So your top row are large cap stocks, your middle row are mid cap stocks, and your bottom row is small cap stocks. So I have the biggest stocks across the top, I have medium sized companies in the middle, and I have the small companies on the bottom. For my columns, I have growth stocks, I have core stocks, and I have value stocks. So here we're looking at growth, in the middle we're looking at core, and on the side we're looking at value. And so what this creates is 9 different squares where I can say, okay, in 2022, how did small cap value stocks perform? And what we see is they produced a return of minus 6.6%. How does that compare to, let's pick on large cap growth in 2022? Well, large cap growth in 2022 right here, down over 40, just over 40%. And so the broad US market was down a little under 20% in 2022. But what we saw is this wide spread of returns, whether you were in large cap, mid cap, small cap stocks, and whether you were in growth, core, or value. As you know, at Masters, we generally have a value tilt in our portfolios, and 2022 is a good example of why. Growth stocks tend to perform a little bit better than value stocks in very, very positive economic times, but they both do well. So they both do well, but growth tends to do a little bit better. In difficult economic times, value tends to do significantly better than growth. And the downside to value is typically and historically has not been nearly as severe as what we see in growth. And so 2022 was a great example of that. If you had a value tilt in your portfolio, like we did here at Masters, certainly you outperformed the broad market. And it was a little less painful, even though you still probably had a negative return in your portfolio, than if you had a significant amount of your portfolio in the large cap or even overall in the growth space of the portfolio. And of course, what you see here, the darling of 2022 was large cap value, which was essentially flat for the year. Again, in the year where the broad market was down almost 20%. But what about 2023? I mean, value looked good in 2022, but how about 2023? Well, we have the opposite trend here. In 2023, we had large growth as the winner, up almost 47%. And we had growth overall, so all growth up 38%, which value was only up 12%. Now, the interesting thing about this is you've heard before about compounding returns. So over time, your returns compound and the original money you put in grows, and then the growth on your money starts to grow, and that's when this compounding happens and your investments really start to grow significantly. Well, compounding goes both ways. So compounding goes negatively just like it goes positively. And so if we put these 2 years together, and again, I'm going to pick on large cap value and large cap growth. I would have been really disappointed with my large cap growth stocks in 2022. I was down 40%. But I would have been bragging about my large cap growth stocks in 2023, up 47%. That feels great. Meanwhile, if I'm a large cap value investor, I'm thrilled. In 2022, I didn't lose money. But in 2023, I was only up 12%. I trailed large cap value by a pretty wide margin. But if we put those two together, who did better? Well, by a non-insignificant margin, the large cap value investor is much better off because they're beyond their principal if they invest at the beginning of 2022 and we measured it at the end of 2023. Because if I was a large cap growth investor, I lost 40% of the value of my portfolio. And so for when I lose 40% of the value of my portfolio, I need more than 40% to get it back. If I started with $100 and I lost 40%, I'm down to $60. I need $40 to get back to whole, which means I need a 66.666666% return to get back to whole. So even though 2023 was a positive year for growth, if you were all in large cap growth stocks from 22 to 23, you're still in the hole, where if you were a value-based investor, you're positive. And that's another reason why we think volatility management is so important when it comes to investing, especially important if you're close to retirement or in retirement. But even for a younger investor, a smoother ride keeps that upwards compounding going better than that downward compounding can really hurt you. So very interesting story. We'll see what 2024, I guess 2024 has to break the tie, but very interesting story there between those 2 years. Now we can't talk about 2023 without talking about the Magnificent Seven stocks. If you follow the market at all, you've probably heard about these. And these were the stocks that really carried the market last year. So you see each stock listed out here: NVIDIA, Meta, Tesla, Amazon, Google, Microsoft, and Apple versus the S&P 500, which you see right here. And what I wanted to show you here was give you the same story of, yes, this group of stocks, fantastic returns in 2023. NVIDIA, for example, was up 239%, if we can do the math on that, in 2023 alone. And even Apple, which amongst all these is the old standby, Apple and Microsoft, were both up plus or minus 50% last year. And of course, the S&P did 26%. I'm happy with that. But if I held these stocks, I did even better. But how should I think about that in terms of what happened in 2022? Because the Magnificent Seven are all large cap stocks, and most of them would be classified as growth stocks. And so what you see here on the bottom row of this chart is the combined return from 2022 to 2023. Now, NVIDIA was the standout here. Between those two, that was up 69%. That's been a great investment. But take a look at Tesla, Amazon, Google. They're still not to whole, even after their great years last year. So for all you heard about the Magnificent Seven, in general terms, the overall market still outperformed even the small group of stocks, despite the fact that they were wonderful, wonderful investments in 2023. And so it comes back to our philosophy, which is we don't want to get too excited about any individual stock or any small pocket of the stock market. These would all generally be classified as technology stocks, large growth stocks in general terms, all of these positions. And so we don't want to get too concentrated in any one spot. We want to take the market. We want to weight appropriately. And in our portfolios, we hold all of these positions. We just make sure we're not holding them in a way that provides excess volatility to the portfolio. But certainly 2023 was a great year for this collection. We'll see what leads the market. And if we have a more broad-based market rally here in 2024. Need to talk about bonds as well. It's been a very unique time for bonds. Up until 2021, we've been in a declining interest rate environment, which goes all the way back to the 70s. So we've had this 40+ year ride in bonds of yields going down. Of course, back there in the late 70s, yields were all the way up in the mid to high teens. And since then, we've had a steady decline of yields. What that's meant for investors is, yes, my yield goes down, but when bond yields go down, my prices go up. So it's been good to be a bond investor. And of course, we learned the hard way in 2022, if we weren't prepared for it, that when yields start to go back up, prices go down. And that can be painful, especially in the bond market. Interestingly, we thought 2023 was going to be a bounce back year. Yields were up. We thought you'd get your 5-6% on your portfolio and you'd be happy about it. And at the end of the day, you did, but it didn't happen until the last 2 months of the year. So this chart shows the monthly returns. Now I reversed it on you from the stock chart, where January is here at the top. And January started off positive, but if we go all the way down to the end of October, the US bond market was negative. So we were staring down the barrel of another negative year in the bond market. Would have been the third negative year in the bond market in a row, which has never happened before. When we're sitting there at the end of October, down 2.44% in the bond market. But November, we got 4.9%. December, we got almost 4%. And so based at a rate of 0, 138% of the total cumulative market return for bonds came in the final 2 months of the year. And so even sometimes bonds require patience, especially in this interest rate environment that we're in. The Federal Reserve has so much influence over what's happening in the bond market. It's created a lot of variables that we really haven't seen before. And so we think patience and a strategic approach to fixed income investing is especially important at this point in time, in this unique time in the bond market. And last year was a great example of that. But if you stuck with your bonds, you ended with a solid return for next year, and you're still sitting here this year with a yield on your bond portfolio of probably somewhere between 5 and 6% to hold high quality corporate and government bonds. So it's a good time to be a bond investor as we look forward, but the ride still may not be completely smooth, especially with the Federal Reserve and all the maneuvering they do that affects the market. And then my last slide on what happened in 2023 gives you a historical return of the US bond market, just to show you how difficult these last few years have been. In 2021, we were down 2% in the bond market. In 2021, we were down 2%. In 2022, we were down 13%. And we thought we might be down in 2023. At our worst point, we had a peak to trough bond return of -7% last year. So still a lot of volatility, but we ended up 6% last year, which is generally average returns in the market. But what you can see is this chart takes you all the way back to the mid-70s, and you see this trend of bond returns going down over time. Right, we had these unbelievable years that we'll probably never see again, like 1982, when bonds were up 33%, hard to even fathom. And we had double-digit returns a lot of years here through the 80s and into the mid-90s. That was because yields were up. Over time, bond returns are driven by yield. And so what you see is when yields were elevated here in the teens back in the 70s and 80s, you were getting these big years of up 15, up 16, up 19, up 10, up 9, and you had really strong bond portfolio. But then when we got down to the interest rate environment we're in today, what you see here, we haven't had a double-digit positive year since 2002 in the bond market. We've had single-digit returns, and especially, as you can see, back to 2012, if you were a bond investor from 2012 through 2022, the average yield through that time was a little over 2%. What do you think you returned in your bond portfolio? about 2% a year, even with that nasty year of 2022 in there. So bonds are driven by yield, and that's positive news for investors going forward, especially investors that are going into retirement and are going to rely more on their fixed income to provide income for them. This is a good time to be getting into bonds, in our opinion, because yields are up and that's what drives returns. So Lyle, that's my recap for 2023. I'll pause there and see what questions we have.
Yeah, thanks, Gary. That was great. Just a reminder, especially those of you who may be joined after we get started, please put any questions that you have either in the chat or the questions section at the bottom of the screen. I'm monitoring that. I don't have any questions in there right now, Gary, but I have a couple additional comments. If you could go back to the stock market, the monthly returns on the stock market last year. A couple things that were interesting here to me. Some of this you touched on briefly, Gary, but just looking at the way the returns came in last year, especially those last 2 months, is just a reminder that the market often comes fast and furious when it takes off. And that's hard for a lot of us who are used to things being steady in our life. We get a steady paycheck. If we put money in the bank, we get steady interest on that. If we have rental properties, we have the income come in every month. So there's many things in our life that work very systematically or very steady, but that's not the case with the way the stock market works. And you have to oftentimes put up with, you can see there, look at August, September, October, you have to put up with 3 ugly months before you got the last 2 months that were really good. And this can happen on months, it can happen on years. I often think back to the early 2000s. Some of you remember those days, 2000, 2001, 2002. We had 3 negative years before we got some really strong returns in the middle of that decade. So yeah, I thought last year was a good year to just point that out, that yeah, you often have to just sit there and wait through a lot of sometimes real ugly times, and then those returns come quite rapidly.
Yeah, Lyle, it's a great point. The analogy that I have for the investing philosophy here is, certainly you don't want to sit still. You don't just want to sit still, close your eyes, and hope that I wake up in 20 years and my portfolio did what I wanted it to. But when you're managing your portfolio, you want to manage around the edges. So you want to decide what your philosophy is and what's at the core of your philosophy. And ours would be, make sure you're properly allocated for the risk that you're willing to take and need to take for your plan, and then diversify within that. So that's the philosophy, and then stay invested and stick to that strategy. But what's around the peripheral around that is all these smaller things that we do to try to enhance expected returns out in the future. So the weights that we put on the portfolio, the way we manage duration in our fixed income portfolios, which we'll get to toward the end, the rebalancing mechanisms that we have in place. All of those things are these things around the edge. They don't disrupt the core, but they add value around the edge. And over time, those things compound pretty significantly. And so the way I think about it is your drive to work. So every day you drive to work, and you probably typically take the same route to work. And so that's the core. I take the same route to work every day. Now, sometimes you're going to run into stuff. You're going to run into construction. You're going to run into an accident. You're going to hit more red lights than you usually do. But if you hit a major accident one day and it takes you 15 minutes longer to work, does that mean the next day you're going to go a completely different route to get there? No, you're not going to change the core. You're going to continue to take the same route. But when major market events happen, like an accident or a crash, what do? Well, we rebalance the portfolio. We strategically weight back to the factors that we want the portfolio to be at. You might take a detour around and go a different way for that one day because of the event that happened. You still make those tweaks, but in general, you're still going to go the same way to work every morning, most days. And so I think that's a good analogy for how we want to invest. We want to make sure we're solid on our philosophy and how we're going to invest. But then we also have these things that we're able to be nimble and flexible when those unexpected things come up and happen.
Yeah, that's great. Thanks for that analogy. I think that does do a good job of explaining our core philosophy there. That's
Great.
I think that's
any
all.
other questions here, Lyle?
I don't see any. I think we're good to move on.
Great. Great. So second part of today's webinar is about valuations. You've heard us talk about valuations before. And so I wanted to start with, why is this so important to us at Masters? Why do we talk about valuations so often? And why is it something that drives our investment philosophy? And the reason that valuations matter is that over time, valuations do correlate with market returns. And so when we look at valuations over time, the higher the valuation, which is just the higher price we pay for a security or for a stock, the less likely it is that we're going to get positive returns out into the future. What you see here is a chart that has a couple of different things going on, but I really just want to focus in on where we sit today. And that's this metric right here. Now, the number itself doesn't really matter. What I want you to pay attention to is this teal trend line. This is a measure of a certain valuation metric that we look at over time, all the way back to 1970. And it's a forward-looking metric. And what it says is where we're at today collectively in the market, are valuations average? Are they a little low? Are they very low? Are they a little high, or are they very high? And that's what you see over time as this chart cycles through. We have times when there's peaks, and I'm going to point out a few of those peaks and see if you can see any themes. So here's one peak in the late 1920s. Here's another kind of mini peak in the late 1930s. Here's one in the mid 1960s. And here's one in the late 1990s. And those things are pretty interesting. Lyle, do you notice anything about those peaks in the market of valuation? Anything that happened right after those peaks?
Sorry, I was muted there a second. Man, it seems pretty coincidental. I think there was some major downturns in the market after that. I think that 44 might have been what I was just talking about. The 3 years that came after that were kind of ugly.
You're exactly right.
And
You're exactly right. We even have this in 2020, Lyle, when not necessarily, we would have thought of 2020 as that was a shock out of the blue recession, but valuations were higher there. And so that's why they matter. Now, to be clear, we've done a lot of research on this, and it's hard to get granular and time the mark, because you might look at this and say, well, if we can see when the peaks are, we would be able to get out or de-risk the portfolio before things crash. But what tends to happen is right when valuations are high, right before we get a market correction, there's a significant acceleration in returns, and then we get the crash. So when we look back at the data, it's just a lot of people have tried to time it, and you just can't do it. But this can indicate, hey, when we're looking at portfolios today, should we be a little more aggressive, a little less aggressive? I'm investing new money into my portfolio. How should I think about that? Should I be quickly trying to dump new money in? Should I drip it in over time because maybe valuations are a little high? And what we see today is right now, we, even with some of the volatility of the last couple of years, we're up in the 5th quintile for average earnings. So what that means, if we break the historical earnings up into 5 categories, top 20%, next 20, and so on and so forth, we're still in that highest bracket right now. And so what that would indicate is, one, we want to make sure we look very closely into our portfolio, understand what we own, understand what we're paying for what we own, and make sure that we think that's a fair price that's indicative of what we're going to expect in the future. And number two, that, yeah, things are still a little expensive. And so for that to correct itself, we either need prices to go down or we need earnings to grow. And so that's why earnings are such an important component of this, because if earnings grow and prices stay the same, these ratios will come down. So there's some of that can go on. But of course, also we have prices go down, earnings stay the same, and this metric goes down as well. So this is not as much of a we think something's coming. It's more of a, okay, let's be thoughtful about what we own in the portfolio, and let's make sure we know what price we're paying for those stocks, because there is still value in the market. Even though the broader market might be on the expensive side, There is still value in the market where we can pay attractive prices for things, which we'll get to. Long term, again, why do valuations matter? What you're seeing here are two different charts. This chart first shows you a valuation and then it's 1 year return. So you have valuation across the bottom, you have subsequent 1 year return on the left side, and in the middle we've got a 0% market return. So what you see is there's some scattering here. When valuations are high, we've got this collection. When valuations are high, sometimes we still have really good years. We have really positive years, sometimes not so much. Certainly there's a bigger collection down here on this side of the chart than over here. But there's times when valuations are lower and they're attractive, and we have bad negative market years. That happens. But what happens when we look at 5-year subsequent returns? That's this chart right here. We get a much tighter dispersion, and we get a much clearer and less steep trend line that shows us when we have lower valuations, the next 5 years tend to be pretty good. When we have average valuations, we're somewhere between a slightly negative and positive 10%. And we look at these negative 5-year returns, most of them have come when we've had higher valuations. So that's why they matter for long-term investors and why we can't time it, because there's still so much uncertainty when we're only looking at these short, small pockets of time, like 1 year forward. So let's take the S&P 500 and where the value on that is today. You see on this chart, 30-year average on the S&P for this valuation multiple we're looking at is 16.6%. Right now, we're trading at about 19.5 times earnings. So we are slightly elevated. You see here in 2022, we dropped back down below the long-term average. And guess what? 2023 was a really, really good year. So we had one of those years that made a little bit more sense. But again, we're looking at this and just saying, okay, let's be thoughtful about where we are in the market. If we go back in time, again, late 90s, early 2000s, we all know what happened there with the tech boom and extremely high valuations that were way out of whack and what followed that. And then, of course, we remember 2008 as well, where we really hit a bottom because the bottom just fell out of the market. But over time, these valuations matter, and so we want to be aware of where things stand today. Now, you remember the chart I showed you from 2022 and 2023. 2022 was almost all red. 2023 was all green. This is another version of it, but is looking at valuations with the same box, where we have small, medium-sized, and large companies. We have value, core, and growth companies, and compares what are they trading at today versus their long-term average. Now, long-term average is a number. It matters, but it's not the end-all be-all. What I think this chart shows you is, even though the broad market, if we look at it that way, is overvalued, we could say that, there are pockets of value still in the market. We look at small cap value. So smaller stocks that trade at lower prices are still under their 20-year average when it comes to multiples that they're trading at. Small cap core stocks also pretty much right on their long-term average. If all we get is average returns in small cap stocks, we're pretty happy because they average about 11% a year over time. So seeing 100% is not, oh man, that's not good. 100% is great, because if we're trading at normal valuations and we get normal returns, the stock market's going to give us that long-term average of somewhere between 8 and 12%. And for all of us, the way we run our financial plans, we're going to be okay with that and be fine. One of the things that's interesting and not super surprising, of course, these large cap growth stocks, they generally trade at a higher multiple. So I'm going to shift your attention over here. And what you see is large cap growth is currently trading at a 26.5% multiple, or 26.5 times. What that means, for every dollar of earnings that a large cap growth stock has today, I'm paying $26.50 for it. Where when I look at large cap value stocks, I only have to pay 14.9 times to access that same $1 of earnings. Now, that being said, growth stocks tend to trade over time at higher multiples than value stocks, which is what you see in the other half of these boxes. Large value historically trades at 13.7, growth trades at 18.9. And so that's why this ratio is so important. And when you start to slice and dice the market, you see that there are pockets of value and there's pockets that may be more overvalued than others. And so what that tells us is we have to be very wary of what's in our portfolio. We have to look closely into the portfolio and make sure that we're not overweight these stocks that may be more highly valued, and that we may want to tilt a little further to the parts of the market that are fairly or slightly undervalued. What about the Magnificent Seven? Are they going to continue their run? Well, maybe they will, maybe they won't. You know, at Masters, we're not prognosticators. So they could do better, they may not, but this would indicate that maybe we've seen the best for a little bit, potentially. Because right now, the Magnificent Seven collectively are trading at 34.3 times earnings. Meanwhile, the S&P is trading at 21.8. And then what you see here is the emerging markets index. So emerging market stocks are only trading at 12 times earnings. And some of the other international stocks trading about 14 times earnings. So yeah, what price are you paying for stocks to access their future growth? If you're paying 34 times earnings for the Magnificent Seven stocks, you are essentially betting that they're going to continue these astronomical growth rates into the future. And so you just have to be aware of that and make sure you're comfortable making that bet. What about on the international side? So I pointed out global stocks last year that had a pretty solid year, didn't quite keep up with the US, but had a pretty solid year. But this is where there's some other opportunity as far as we see it if we're looking at it from a valuation standpoint. This compares what are international stocks trading at versus what are US stocks trading at from an earnings standpoint. This goes back to the early 2000s. What you see here is that generally international stocks trade at a discount to US stocks, which makes some sense. We're the biggest economy in the world. We're the most developed economy in the world. We have the most robust economy that there is and that there's ever been for the period of time that it's been around. So it makes sense that you trade at a discount. But back there in the 2000s, the discount was not super significant because this chart starts in 2004 and US tech stocks crashed in the early 2000s. But this trend that we've seen is over the last almost 10 years now, the discount has grown bigger and bigger and bigger. We're now, actually right now, almost today, we are at an all-time low discount of what I'm paying for stocks in global markets versus what I'm paying for stocks in the United States. And so that's really interesting because it would indicate that there's more potential for growth because I'm paying such a lower price to access the earnings of these global companies than I am in the United States. And so again, I need to look closely at my portfolio and think about my allocation, even though the United States has outperformed global stocks pretty handily for the last decade. Where's the opportunity today? Well, from a pure price standpoint, appears to be some opportunity on the international side. This is just a different way to slice and dice these numbers. What you see here is the gray bar is the average valuation of international to US, and the purple dot is where they're trading today. And so if the purple dots were over on this side of the chart, it means that international's more expensive than the US. But look at this, even across every sector, international stocks are trading historically at a discount to the United States. And the discount is extreme in a lot of areas, such as financials, such as energy, materials, consumer discretionary. So this isn't just one pocket of the market or one country. This is really across the board. It appears there's some value out there in the international side. Lyle, I'm going to pause there and see what questions we have on valuations.
Yeah, this question has to do with, like, if you're, let's just say you're a 10-year investor, you've got some time frame, and you how much do you use this data to actually make a decision today about investing? So, you know, it seems like on evaluations, we're a bit high today in the US stock market. Obviously, what you just showed us, we're a bit low in the international markets. And then another piece of the puzzle is we've got decent yields on the bond market now. So how much do we use this to, I mean, should we be being a little bit more cautious today if we're investing for, say, a 10-year period of time, if we have a sort of a moderate objective? Or should we not really factor much of this current data into a longer term decision? What are your thoughts on that?
It's a great question, and it's a delicate balance. No, we don't want to overvalue data at any given point in time, but we don't want to ignore it. And so the way I think about that question is, well, we don't want to change the core. Okay, so we would say it's not reasonable to say, oh, I look at yields up on bonds, valuations high in the US market, I should get more conservative and see an investor who should be in a 60-40 portfolio go to a 0-100 portfolio. Or if valuations are really low, oh, I'm going to put all my money in stocks. Now, most of us wouldn't do that anyway, but that's where we want to rein it in. What we might say is, okay, let's say I'm getting close to retirement. Let's say I have good cash flow and I have excess cash flow to invest. Where should I invest that today? We might say, well, maybe we invest a little bit more of that into fixed income, even into cash, just to preserve your capital for the short term so that we can maintain your stock portfolio over here. And even if we do get some bumpy ride here over the next few years, we're okay because we've reserved capital for the short term. So I still think about it in time horizons. But the other thing that we do here at Masters that in a way takes care of itself when it comes to these things is this simple rebalancing system that we have. And I say simple because the concept's simple, the execution is rather complex, but we have a system for it. And what that rebalancing mechanism does is say, hey, when one part of my portfolio does really, really well, I have a system that says I want to take some of my gains in that part of the market that's done really well, and I want to put that into a part of my portfolio that hasn't done as well. And so I'm systematically buying high and selling low. And so if you have this mechanism in your portfolio, which if you invest with Masters, you do, what is happening in your portfolio is we're shaving positive returns off of, for instance, the US growth side of your portfolio and adding a little bit to the international side. Not in huge chunks, but a little bit at a time to keep things in balance and continue to sell high and buy low. Does that answer your question, Lyle?
Yeah, I think that's good. I mean, I guess just a little bit more comment on that is, on the short term, it could, again, I think time frame is always the first thing to look at. How long what's our likely time frame for investing? But then you're going to look at some of this data and potentially tweak things a little bit on your aggressive level. So, somebody might say, well, I'm a little bit cautious right now. So, bumping a 60-40 back to a 50-50 or something is something we would do on a regular basis if a client wanted that done. But yeah, we certainly don't want to overdo it on the current data because things change so quickly.
Yeah, now, one other thing I would add to that, Lyle, too, is if you don't have that rebalancing mechanism in place, and let's just say in your 401k, you had an overweight to these large cap growth stocks that did really well last year. What I would use this data to do is say, maybe I should take some of those gains, reinvest in these other parts of the market, and just make sure I continue to have a balance in my portfolio and take advantage of the fact that worked really well for me last year by taking some of those profits off the table.
Yeah, that's great. Good. I think that's all for now.
Great. Well, I'm a little long-winded today, so we're going to run a little short on time. So I'm going to zoom through this last section, which is about investing for income. This is a theme that's come up in a lot of our client conversations over the past year with yields up. And so we thought it'd be helpful to shed a little bit of light on how we view this. And again, of course, there's some data behind it and there's some charts behind it. But to start, just a few things on the philosophical side. One of the things that's really interesting about dividend investing, so buying, let's say stocks for now, just focus on the stock market, buying stocks that pay higher dividends, is when we look at the data, there's no evidence to suggest that dividends are a factor, that if you weight your portfolio toward dividend paying stocks, that that's going to lead to higher expected returns in the future. And so we don't manage our portfolios to specifically weight toward dividends. However, there's two factors we do weight toward that have shown to lead to higher expected returns. One of them is profitability. So more profitable companies generally do better than less profitable companies. And price. Lower price companies tend to do better than higher price companies. Companies that pay dividends tend to be more profitable and tend to trade at slightly lower prices. So what happens if you screen for these factors like we do, you do end up with more dividends coming into your portfolio, but dividends in and of themselves have not shown any viability to lead to higher expected returns. Another thing to be aware of in non-retirement accounts is that dividends are in most cases less tax efficient than capital gains. One of the main reasons for that is you don't control when they come into your portfolio. With capital gains, in most cases, you can control when you realize capital gains in the portfolio. And so that's something to be aware of, especially in a non-retirement account. Of course, it doesn't really matter in a retirement account, but in a non-retirement account, make sure you're not exposing yourself to excess tax risk just to get a little more income. Because you know what? Income in the form of dividends versus income in the form of appreciation on your stocks, they still get you to the same place. So the way we view it is income tends to be a byproduct of these other investment factors, but it's not a factor in and of itself. And reaching for yield, looking for higher dividend investments, if we go too far on that, can bring additional risks into the portfolio. So what are some of these alternative asset classes that pay higher dividends than average? Maybe this is something that you've seen before, maybe it's not. But right here in the middle, this is a 10-year treasury bond. So a 10-year US government treasury bond, right now yielding about 4.4%. US corporate bonds are right here, averaging about 5.6%. And so if you have a core bond portfolio, you blend those two together, again, your yield right now is about 5%. What if I want more yield? What if I'm trying to reach for more yield in my portfolio? Well, what I have to do is I have to take more risk. I have to go into preferreds, which are stocks. On this chart, the green bars are stock investments. The blue bars are bond investments. The gray bars are where considered alternative. They're neither. They're in their own asset class, something unique. So for me to get more income, I have to invest in stocks, which of course are more volatile than bonds. So in this case, if I'm comparing preferreds versus US corporate bonds, I'm saying, okay, do I want to take stock-like risk just for another 0.8% a year in dividends? At Masters, we would say, no, that's not wise. Let's just have our bonds be bonds and have our stocks be stocks. And then when you get up here, there's some other attractive investment opportunities. What about US high yield? That's still a bond. It is still a bond. Right now, they're yielding 8.4%. Oh, so you're telling me I can buy a bond that yields me 8.4%. Yes, you can, but you're buying a bond that is almost perfectly correlated with the US stock market, which means that when the stock market goes down, high yield bonds generally go down as well, where traditional bonds like government bonds or corporate bonds tend to move in different directions than the stock market, which is one of the benefits of having them both in the portfolio. So that's what we're talking about with these added risks. And some of the other things on this chart are probably things that many of you have never even heard of, and certainly not areas that we would suggest it's wise to invest in. Another piece of this risk goes back to that correlation factor. And I think this is a really, really fascinating chart. On this left side, you have yield, and on the bottom side of this chart, you have the correlation to the S&P 500. So again, a correlation of 1 means that when the market goes up, so does this other investment. They move the same, and when they go down, they go down. And what you see here is the higher the yield on this investment, the stronger their correlation to stocks. So the more interest they pay, the higher dividends they pay, the more like stocks they are. And so what we say at Masters is, hey, if you're looking for this type of return that comes in these types of higher income investments, you're better off just owning traditional stocks than owning something like US high yield. We want our bonds to be like bonds, and they have negative correlation, which means when the market goes down, these hold water or go up, even though they pay a little bit less income. So we have to be a little careful with this income investing idea. Where do we go from here on interest rates? Of course, none of us know, but the Fed funds rate, they have their own expectations of where things are going to head. Right now, the Fed funds rate's at 5.38%. What you see on these charts are what they expect for the future. The blue line's what the Fed's saying, the green is what the market is saying, and they're pretty much in lockstep to think that long term, the Fed funds rate is going to end up somewhere around 3% over the next 2 to 3 years. Of course, the Fed's long-term target's 2.5%. We'll see if they get there, but it's not unlikely to say we're probably at somewhere around the high water mark of short-term interest rates. And we just have to think about what that means for portfolio positioning going forward. As far as yields across the spectrum, the yield curve is still relatively flat. What we're getting on a short-term bond, pretty close to what we're getting on a medium-term bond, pretty close to what we're getting on a long-term bond. And so we just, again, have to think about how we invest in that. Two things I'll compare here that are really interesting. 30-year government bond right now yielding 4%, 2-year government bond yielding 4.2%. Would you rather give your money to the US government for 30 years or 2 years if I'm getting the same interest rate? Most of us would probably say 2 years. But we also have to think about if that 2-year rate's going to go down in the next couple of years, which it seems like it will. I probably want some of all of this together to hedge my risks about what's next. And that comes to the conclusion on income investing for us. The way we invest for income depends on what the yield curve looks like. And so when we have what we would call a normal yield curve, which is one where short-term rates are lower than higher term rates, typically the best bang for your buck is in the longest term bonds. When we have a relatively flat curve, just a slight upward shape, we want to be right smack dab in the middle. Oh, if I can circle it properly, right smack dab in the middle. When we have an inverted yield curve, which is what we have today, it's not this extreme, but it's close to it. We want to be on the shorter end of that yield curve. That's where the value is. And so what you'll see in our portfolios is right now, because we have this inverted yield curve, we're still weighted to shorter term bond holdings. But as that yield curve starts to work itself out, starts to flatten out, and then at some point get back to normal, slowly but surely, we want to make the duration in our portfolio just a little bit longer to make sure that we're maximizing the value. And so this is the importance of fixed income and income investing is you have to move with what the market's giving you. And this is how we do it here at Masters. Lyle, that's what I have on income. I saved 2 more minutes for another question or two here before we wrap up.
I don't have any questions in the chat. Just yeah, it was just a good overview, and yeah, certainly on the yield curves, the market's at least showing that at some point the short-term rates are going to start going down. Who knows if that's in a few months or later this year, but that's certainly what the market thinks is going to happen.
Yeah, that's exactly right. That's what the market expects. That's what the Federal Reserve expects. That's what they want. So I think what you need to consider now if you're an investor is if I don't think about the future and I just look at things today, I'm going to put my money in cash and 1-year bonds because I can get 4.5%, 5% on cash and 1-year bonds. Meanwhile, I'm only getting 4% on a 10-year bond. Why would I tie my money up for 10 years when I can get this short-term rate? But the risk you have there is the reinvestment risk. If in 1 year that short-term bond or that cash turns over and rates have gone down now to 3.5%, it's going to be harder for me to get into those long-term bonds because those are going to get more expensive. And so we're still weighted to that short end of the curve, but we are slowly adding in some of that medium-term duration just to start hedging that bet, not make a prediction, but just hedge that bet that over time this has to correct itself one way or the other. Either short-term rates have to come down, medium and long-term rates have to come up, or a combination thereof.
Yeah, that's great. Thanks, Gary, for all your insights and the work that you put in each time to prepare the slides and to go through that with us. Appreciate it. It's really good data and just gives us some, like you said at the beginning, gives us some perspective on what's happened and a little insight on what we should do, what we should expect for the future.
Absolutely, Lyle. Thanks everyone for being with us this afternoon. We greatly appreciate your friendship, your relationship with Masters. Certainly anything we talked about today that you have questions about or you want to talk further about, especially as it pertains to your specific situation or your specific portfolio, please send us an email, give us a call. We're happy to talk with you and help you however we can. And we hope you have a great rest of the day. Go out and enjoy this beautiful weather, and we'll see you all soon. Thank you.
Yep. Thank you. Bye now.